an in-depth study of asset management, exploring the products, strategies, and operations of the industry. Presentation overview. Asset management industry. Asset management industry is a vast industry that includes a range of products and services, such as mutual funds, pension funds, and hedge funds. It plays a crucial role in the global financial market. Products and services offered. Asset managers offer a range of products and services such as mutual funds, exchange-traded funds (ETFs), private equity, and hedge funds. They also provide investment management, financial planning, and advisory services. Investment strategies. Asset managers use a range of investment strategies such as value investing, growth investing, and quantitative investing to achieve their investment objectives. They also use active and passive management approaches. Business operations. Asset management firms have complex business operations that include investment research, portfolio management, trading, and client services. They also have to comply with regulatory requirements and manage risk effectively. Industry overview. Asset management is a vital component of the financial industry, involving the management of investments on behalf of clients. The industry is made up of various types of asset managers, including institutional, retail, hedge funds, and private equity firms. The growth of asset management has been fueled by the increasing demand for investment products and the rise of passive investing. Definition of asset management. Asset management is the process of managing clients' portfolios of financial assets such as equities, bonds, real estate, and commodities, with the goal of maximizing returns while minimizing risk. Investment advice. Asset managers provide investment advice based on clients' objectives and market conditions. They help clients identify investment opportunities and execute trades to achieve their goals. Risk management. Asset managers strive to manage risk and minimize losses for their clients. They use tools such as portfolio diversification and hedging to manage risk and achieve a balance between risk and return. Types of asset managers. Traditional asset managers. Traditional asset managers use a variety of strategies to generate returns, including long-only strategies, multi-asset class strategies, and income-oriented strategies. Alternative asset managers. Alternative asset managers use non-traditional strategies to generate returns, including hedge funds, private equity, real estate, and commodities. Passive asset managers. Passive asset managers aim to replicate the performance of a benchmark index, such as the S&P 500, by investing in a portfolio of securities that closely tracks the index. Size of the industry. The asset management industry is a large and growing industry, managing over $100 trillion in assets globally as of 2020. The top 20 managers alone managed over $50 trillion in assets. Products and services. Investment products. Asset managers offer a range of investment products, including mutual funds, exchange-traded funds, ETFs, and separately managed accounts, SMAs. These products provide investors with exposure to different asset classes, such as equities, fixed income, and alternative investments. Investment services. Asset managers provide a variety of services, including portfolio management, financial planning, and retirement planning. These services are designed to help investors achieve their investment objectives and provide them with personalized investment advice. Types of investment products. Mutual funds. Mutual funds are professionally managed investment portfolios that pool money from multiple investors to purchase a diversified mix of stocks, bonds, and other securities. Exchange-traded funds, ETFs. Exchange-traded funds are marketable securities that track indexes, commodities, or baskets of assets, similar to mutual funds but trade like a stock on an exchange. Hedge funds. Hedge funds are managed investment portfolios that use advanced investment strategies such as short selling, derivatives, and leverage to generate high returns. They are generally only available to accredited investors. Private equity funds. Private equity funds are managed investment portfolios that invest in privately held companies and other non-publicly traded assets. They are generally only available to accredited investors. Differentiated services. Asset managers offer differentiated services to meet the needs of different segments of the market, including personalized portfolio management, financial planning, and customized investment solutions. Target market. Institutional investors. Asset managers target institutional investors who are large organizations such as pension funds, endowments, and insurance companies. These investors typically have a long-term investment horizon and relatively high risk tolerance. High net worth individuals. Asset managers target high net worth individuals who are wealthy clients. These clients typically have specific investment objectives and a relatively high risk tolerance. They're looking for tailored investment solutions that meet their individual needs. Retail investors. Asset managers target retail investors who are individual investors. These investors typically have shorter investment horizons and lower risk tolerance. They're looking for investment solutions that are easy to understand and meet their financial goals. Investment strategies. Investment philosophy. Asset managers have a unique investment philosophy that guides their investment decisions, which is informed by their experience, expertise, and market analysis. Portfolio management strategies. Asset managers use a variety of portfolio management strategies, such as diversification, asset allocation, and active management, to achieve their clients' investment objectives. Risk management approaches. Asset managers use a variety of risk management approaches, such as hedging, diversification, and option trading to mitigate risk and protect their clients' investments. Investment philosophy. Value investing. Value investing is an investment philosophy that focuses on buying securities that are undervalued by the market and holding them for the long term. This philosophy aims to generate returns by buying assets that are trading below their intrinsic value. Growth investing. Growth investing is an investment philosophy that focuses on buying securities of companies that are growing rapidly. This philosophy aims to generate returns by investing in companies that are expected to grow at an above average rate. Income investing. Income investing is an investment philosophy that focuses on generating a steady stream of income from investments. This philosophy aims to generate returns by investing in securities that pay regular dividends or interest payments. Portfolio management, asset allocation. The asset allocation process is a crucial step in portfolio management, involving the selection of a mix of different types of assets, including stocks, bonds, and other investment options. Security selection. Security selection process involves identifying individual assets that are expected to perform well based on the asset manager's analysis of market trends, company performance, and other factors. Risk management. The risk management process involves taking steps to minimize the impact of any potential losses or negative outcomes associated with the assets in the portfolio. This can include diversification, hedging, and other strategies. Risk management. Asset managers use a variety of risk management techniques to manage the risk of their portfolios, such as diversification, hedging, and use of derivatives. These techniques help to reduce the risk of losses and protect the value of the portfolio. Business operations. Sources of revenue for asset managers. Asset managers generate revenue from various sources, including fees charged to clients for managing their assets, commissions earned from buying and selling securities, and performance-based fees based on the performance of the assets under management. Cost management strategies. Asset managers use various cost management strategies to reduce costs and increase profitability, including outsourcing, automating business processes, and reducing headcount. Compliance and regulatory landscape. Asset managers must comply with various regulations and standards set by governing bodies and industry organizations to maintain the integrity of the asset management industry and ensure transparency and accountability. Sources of revenue. Management fees. Asset managers generate revenue by charging management fees, which are typically a percentage of the assets under management. Management fees provide a stable source of revenue for asset managers. Performance fees. Asset managers can earn performance fees for outperforming the benchmark. Performance fees provide an incentive for asset managers to achieve better returns for their clients, but they can also lead to conflicts of interest. Commissions. Asset managers can earn commissions by selling financial products such as mutual funds or insurance policies. Commissions provide an opportunity for asset managers to earn additional revenue, but they can also lead to conflicts of interest. Cost management. Fixed costs. Fixed costs are expenses that do not change with the level of production or sales, such as salaries and rent. Asset managers need to manage their fixed costs effectively to be profitable. Variable costs. Variable costs are expenses that change with the level of production or sales, such as trading fees and research costs. Asset managers need to manage their variable costs effectively to be profitable. Compliance and regulatory. Anti-money laundering, AML. Asset managers need to comply with AML regulations to prevent money laundering and terrorist financing. These regulations require them to perform customer due diligence, monitor transactions, and report suspicious activities. Data privacy laws. Asset managers need to comply with data privacy laws to protect the confidentiality and security of personal data. These laws require them to implement appropriate technical and organizational measures to prevent unauthorized access, use, or disclosure of personal data. Investment restrictions. Asset managers need to comply with investment restrictions to ensure that they invest in accordance with the client's objectives and risk tolerance. These restrictions may include limits on the types of assets that can be invested in, the proportion of assets that can be invested in, certain assets, or geographical restrictions. Conclusion. Asset management industry overview. Asset management is a complex and dynamic industry that plays a critical role in the broader financial ecosystem. Products and services offered by asset managers. Asset management firms offer a wide range of products and services, including mutual funds, exchange traded funds, and separately managed accounts. Investment strategies used by asset managers. Asset managers use a variety of investment strategies, including value, growth, income, and index investing, to achieve their clients' investment goals. Business operations and asset management. Asset management firms rely on a variety of business operations, including research, trading, compliance, and risk management, to provide value to their clients. Thank you.